again, St. Louis. Welcome to What Retirement Means to You with Jerry Means of the Means Financial Group. I'm your host, Spike Spangle. Every single week, Jerry, you provide retirement planning solutions for retirees. How you doing this week?
I'm doing fantastic, Spike. How are you doing?
Very good, although you have teed up for us that we're going to be talking about some of the risks that keep people from being able to be and stay retired. Ready to jump into some of those black holes, those speed bumps that keep people from retiring?
I think so. I think it's what's on everyone's mind that's out there. It's what I'm hearing when people are coming into my office or calling into the office. So I thought it'd be good to do a show just kind of addressing those things.
Oh, wonderful. Of course, we're going to talk about longevity. We're going to talk about market risk, even legislative and tax risk. But I think number one that we've got to address right now, especially because of the last 6 months, the last 12 months, inflation. Inflation. To somebody who's living on a relatively fixed income, inflation has been a really terrible word. What has your client base experienced, and what has it been like for some of the folks who have called your TV show recently?
Well, it's not just my clients have called in. I mean, I'm seeing it myself, right, in my own personal life. I mean, the other day I was coming home from the office. My wife asked for me to stop and get, milk and eggs. And I normally don't do the grocery shopping. She does it. But she just asked, hey, will you stop by and pick up some milk and eggs? And when I got up to the register, it was like $16. I couldn't believe it. So it made me really look at, what is eggs cost today? It's $6 for a carton of eggs. So I went back and said, well, what did it look like 30 years ago? It was 91 cents. Mm-hmm. I mean, how crazy is that?
I know. Chicken labor has just gotten out of control this year. But no, I've seen it everywhere. Same thing in grocery store I went to where they said they limited it to 2 cartons per family. So not only is inflation there, but it's limiting and it's difficult for folks. So for people who you talk to all the time, let's talk about clients that maybe you've had a long time ago, right? They've had to see the squeeze of their costs. How do you help them address that?
So I started in the business 23 years ago, about 1998. And so I went back and I actually looked at, some of my clients, some of my oldest clients or clients that have been with me the longest. Mm-hmm. And I have clients that have been with me for 20 years. So the thought of that, like looking at those eggs that went from 91 cents to $6 a carton, my clients over the last 20 years or 30 years, I'm sure they didn't think that they were going to see that kind of inflation on their groceries. I always use the acronym MUG, mortgage, utilities, and groceries, right? Those are the things you have to look at.
Got to fill your mug.
Those are your necessities, right? You got to be very cautious. Make sure you have enough money to provide for those things in retirement. So I've looked at some of those, but in my financial planning over the years, I've always accounted for 2 to 3, maybe 2 to 4% inflation. But what we've seen over the last 2 years, we're hoping it doesn't last, right? But now it's made us adjust the way that we plan. Those clients, we put some safe faucets in there for them to turn on more income over the years for income, for those sorts of things. But going forward, it's even more important to have that in your plan. What is it going to look like? If you retire at 65 and you live to be 95 in retirement, that's 30 years. Social Security, the increases on Social Security income doesn't keep up with the inflation that we've seen, right? They did give us a bump on Social Security.
They gave us a nice one this last year, over 8%, but sometimes there's 0.
Correct. And over time, it hasn't kept up. If you look at pensions, most pensions are fixed. If you're lucky enough to have a pension, it's fixed income. Mm-hmm. So you're looking at 30, you have to have income from other sources. And how do you do that if you don't, without taking too much risk in your portfolio? You can't get guaranteed income from a non-guaranteed source. So I think that's important.
So I'm guessing then, have you had clients that started with you? They were in their 60s, and so if you started over 23 years ago, so do you have some clients now who are in their 80s that you've seen go through this? You put together this income strategy? Any folks for real?
Yeah, and I tell people, I have these clients, Cindy and Paul, and they've been with me about 20 years. And we had to go back and kind of do some reevaluating. Like I said, we had planned for inflation, 2 to 3%, maybe 4%. But not for 8, 9%. So they're seeing, over the last 20 years, they've seen that they need more money at the end of the month for some of their necessities. So I always tell people financial planning is not an event. You don't go into a financial planner's office or sit down with your spouse, do a financial plan, and then you're done. It's an ongoing process. Sometimes you have to pivot, you have to make adjustments, and it's always good to have a sounding board to do that with.
So with your clients, Cindy and Paul, there was no extreme. They weren't totally worried. You were able to what? Turn on other faucets, or had they had enough in earnings because of the 13, 14-year bull run that it wasn't a big concern?
Yeah, I mean, they had their Social Security, their pension, but then we set up different buckets. I always like to use the bucket strategy because people understand that. And we had that inflation bucket. Okay, if in 10 years we need to draw more income, where are we going to pull it from? And then we also had the growth bucket. So they did want to have some market risk, but we wanted to limit that risk for the back end. So when they were going through those times like 2001, 2002, or 2008, they weren't dipping into that growth bucket when the market was down. We were dipping into that income bucket that we'd already established for them. And I think that's really important to segment that money for those different reasons.
So for somebody who's watching your program right now today, maybe they're thinking about retiring in a year or 2 years from now, or maybe you just started out your retirement, inflation as a risk in retirement. What are you thinking about going forward? Are you going to stay with 2 or 3% numbers, or do we have to go a little bit higher for the next few years?
I don't think we can really plan for an 8% inflation factor. Okay,
I hope not.
Hopefully we don't have to worry about that at 8% per year. But I think we may need to make an adjustment to that 4 to 5%, at least in the short term, and make sure that inflation does come down. I don't really see that happening. I know that the Fed is trying to curb inflation, but really what we're seeing is the stock market is going down. People have less money to spend. So even if things are cheaper, they have less money in their pocketbook or less money in their savings.
Right.
So that's something.
And then most of that money goes to MUG, as you like to say, your mortgage, your utilities, your groceries. You want to make sure we've got that floor covered. Speaking of, we're going to continue to talk about risks in retirement. Right now we're on inflation. Will you talk about the on-track retirement review? For somebody who might be looking at going into retirement in the next few years, they're serious about retirement planning, what does the review do for them?
So if you come into our office, what we're going to offer is the on-track retirement review. We're going to sit down with you and we're going to look at your entire portfolio. We're going to look at the taxes that you're paying and see if there's anything that we can do there, and also see what we can do to help you in the future for increasing taxes. We're going to look at your income plan, and we're going to design a written income plan. We're not going to talk about it in theory. We're actually going to design and put into place a written plan that will cover inflation. So give us a call, 844-878-1293, and we'll set up that on-track review for you.
Jerry, we've got to take a very short break right now. Folks, call the phone number you see right here, or you can use the QR code if you'd like to answer some retirement questions. It's going to take you over to a little quiz, and then we'll get back to you after that as well. But for the on-track retirement review, call the phone number you see right here so we can get you in, take a look at your investments, your tax situation, estate planning, health choices, all that and so much more, like Jerry talks about every single week on his program. 844-878-1293 is the phone number. More with Jerry Means right after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Welcome back to What Retirement Means to You with Jerry Means. He is the founder of the Means Financial Group right here in St. Louis. I'm your host, Spike Spangle. Every single week, I get to join Jerry in retirement planning solutions for you, our viewers. Interest rate risk, it's a big one right now. I guess if you're trying to buy a home, people have seen for the last 12, 14 months, interest rate risk, not very good, right? You can buy less home, it's going to be more expensive. On the other hand, interest rate risk, if you're an investor, if you're investing in bonds, I would think that's good if interest rates are going. Can you explain to me why interest rates are a risk to a retiree in retirement?
Well, interest rates are part of the entire risk of a portfolio. Historically, we would put money into stocks and bonds, right? Bonds are supposed to be the safer part of the portfolio. I kind of have to take you back a little bit. When I started in 1998, interest rates were high back then. I mean, I remember showing people 9% guaranteed rates, right? Or 9% yields on bonds. But people weren't attracted to that then because we were in a stock market boom. We were in the dot-com. Didn't call it the technology boom back then. We called it the dot-com.
It was the dot-com, yeah. If it had a dot-com behind it, it was supposed to explode.
Yeah,
supposed to
and
go
people
up in
were
value.
making 35% per year. Who wanted to hear about a 9% fixed rate, right? But as we know, a lot of those dot-coms are no longer around anymore. So I kind of see, when I started in my career 23 years ago, interest rates were high. And for the last 23 years, I've watched interest rates on a decline. In the 2000s, we had the Fed cutting interest rates down to next to nothing. So savers couldn't get anything at the bank. It forced them into the market, drove the markets up. But you really have to understand how bonds and interest rates work. Spike, do you remember on the playground? I don't know if they have these anymore, but we had the old seesaws. You sit on one end like we are now on the other end.
Okay, the
and we teeter up
right?
and down, right? So that's how interest rates and bond values work. When interest rates are going down, bond values are going up.
Which is what we've seen for nearly 30 years.
Yeah,
right?
30 years.
Interest
And
rates
23
come
years
down,
of my
down,
career
down.
for sure, right? So that plan worked. You could put your money into bonds. If the stock market was fluctuating, going up and down, at least you had money in bonds that were going up as interest rates were going down. Last year in 2022, it was the first year in the history of the stock market that both stocks and bonds had double-digit losses in the same year. Never had happened before. So you think about some advisors out there that have only been in the business 7 or 8 years. They haven't even seen market volatility, really. We've seen a little bit during the pandemic, but it bounced back so quickly. They haven't really had to deal with that diversity. But think about 23 years, 25 years of never having to deal with a rising interest rate environment. So many people are trained to put their money into bonds because that's a safe part of their portfolio. Target date funds are a big part of that. You put your money in.
Don't get me started. You know, you get both of us started on target date
401ks,
funds.
you put in a target date fund. I'm going to retire in 2026. All that does is mean they're going to buy more bonds than stocks because it's supposed to be safer and it's a shorter time horizon. But if interest rates are going up, that bond portfolio is just as volatile as the stock market, if not more.
Right. And people who are getting closer to retirement last year in their target date funds, the theory of them is you move from stocks over to bonds where you're supposed to be less risky, and last year you were just doubling down on your losses.
Yeah, you were just feeding the machine that was going down, right? So you have to be very cognizant of that. Another way to put it is if you have a bond, let's say it's a $1,000 bond, let's use a small number.
Okay.
And you're getting a 4% interest rate or 4% yield on that bond.
Okay.
And you need to sell it before maturity, but now bonds are paying 8%. Who wants to buy your 4% bond? So it's devalued. People will buy it, but they're going to pay a lesser
So if
dollar
I
amount.
held on to it for the duration of it, I would still be getting my 4%. Because you say people are losing money in bonds. I lose it when I sell it.
Correct.
Because nobody's going to pay me a full par value on $1,000 at 4 when you can get out there and go get 8%.
Correct. And here's the other thing, though. If you hold it to maturity, you're going to get your money back, right? That's the whole idea with a bond. You put it in for a certain period of time. You get a fixed interest rate, then you get the return of your premium. But what we also find, like you said, when you're buying a mortgage, credit cards, things like that, when interest rates are high, you start to see more defaults. So if a company defaults, you don't get your money back. You're a creditor to that company. So a lot of times in a rising interest rate environment, you also will see more defaults on bonds.
Well, and then as the person who's helping retirees invest their money, why was interest rate risk so rough last year? Were you seeing too many people who were trying to jump out of the stock market, going over to bonds and losing and just kind of doubling down all throughout the year, as you said?
Yeah, because that's what they've been educated to do over the years, right? Put your money into bonds. It's a little bit safer. They didn't realize, because in 30 years we haven't seen it, that interest rate seesaw effect. So when people are coming into my office, I'm trying to educate them. It's one of the things I do in almost every meeting is I'm getting on the whiteboard, or if it's a screen share, I'm doing it, through a Zoom call, and saying, hey, you really need to understand how bonds work. The other thing you have to look at is, right now, the short-term rates are better than the long-term rates. I mean, don't you think it makes sense that if you're going to buy into a 10-year commitment, that you should get a better interest rate than buying into a 5-year commitment?
You do the long, and you're supposed to get a bigger number because it's there for a longer period of time.
Yeah, and what's happening right now is those 3- and 5-year yields are higher or as high as a 10-year yield. And they often call that the inverted yield curve, right? And not to get too much into the jargon, but basically when long-term rates are lower than short-term rates, and historically that's led to a recession. Now, I'm not a doomsday guy. I like to stay positive because there's things that we can do to adjust for this. But it's really important for people to know, just because you're in a target date fund that says you're going to retire in the next few years, that your portfolio is in a safe investment.
Right, and or just going to bonds in general. So I think part of the message that you're saying to folks is be careful what you think you know. This environment is totally different than it's been over the last 20 to 25 years. Thankfully, you've seen these things a few times over. But like you said, the stock and the bond market correlated together. First time in well over 40 years. I think it happened 2 or 3 times in U.S. history, but it's not very frequent. So this retirement time is very dangerous for folks. When you do an on-track review, how do you help evaluate people's investments?
Well, I think it's really important for people to think outside the box. We have to use some alternative investments. I'm actually steering most of my clients away from the bond part of their portfolio and looking at other fixed income investments. And that's something that I cover on the on-track review. So we're going to offer that to the next 10 callers. If you come into my office, sit down with me, we're going to talk about interest rate risk. We're going to talk about the volatility in your portfolio. If you're in a 401k, we're going to talk about, are you allocated correctly? Is your portfolio as safe as you think it is? We're going to look at longevity risk, and we're going to look at long-term care or healthcare risk. Give us a call, set up that on-track review. There's no cost, no obligation. The number is 844-878-1293.
Folks, we're going to take a very short break, but as Jerry said, for the first 10 calls, we're broadcasting all around St. Louis, so as you can imagine, Jerry's schedule fills up pretty quickly. So please come in and get your on-track review. This investment atmosphere that we're in right now is completely different than what we've experienced over the last 10, 15, 20, 25 years. So if you're just moving into retirement, you need to get a review and a plan that works for you. Call 844-878-1293. More what retirement means to you with Jerry Means right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to What Retirement Means to You with Jerry Means. I'm Spike Spangle, and every week Jerry talks about solutions for retirement planning. Right now, we're talking about the different risks. And it's not to scare people. Like you said, you're a very, very positive person. But if we don't address the risks, people will continue to face them over and over again. So I want to ask you about market volatility. There's not a lot that any of us can do to stop the market volatility. How do you help, can I say, control it for your clients or mitigate it, if you will? I always hear that phrase in our industry.
Well, I think that's the key. Is I do want to talk about market volatility because it is what I'm hearing the most from people that are calling into the show. People just like you, they're sitting there, they're wondering, Have I done things right? Am I going to be okay? And that's what I hear when people come into my office. Number one question, people sit down and they say, Jerry, I'm thinking about retiring, or I'm already retired, and I want to know, am I going to be okay? That's it. It's really simple. I mean, they have other questions, but that's really what it all comes back to. I had a client recently, or prospective client, she's a client now, but when she came in, she had watched the TV show. She had been working with an advisor for a long time. She was very comfortable with him, but he retired. She got handed over to the advisor that kind of took over the book of business. It was with one of the big box firms, but she said she was really happy and comfortable with them over the years. But she felt like now that she was retiring, she wasn't really getting the questions answered that she had. She had questions about Social Security. She was worried about what was going to happen if she needed some type of long-term care. She was worried about her Medicare premiums going up if she withdrew too much money. And her advisor really wasn't talking to her about that because he was more of an accumulation advisor. You know, and I asked, I said, well, what kind of risk are you comfortable with? She said, well, I used to be okay with risk, but now that I'm older and, you know, I'm at retirement, I'm not comfortable with it, especially what's been going on lately. So I asked them to kind of, you know, pull that back and put it into more of a conservative portfolio. And I said, okay, well, that's great. You know, let's take a look at what they did for you. So she left. I took all of the statements that she had given me, and we did some analysis. And when we came back to it, we looked at it. She was 80% stocks or equities and 20% bonds, which historically is an aggressive portfolio. It's not even a moderate portfolio.
That's what you do when you're 14. You don't invest 80-20 when you're at retirement.
Well, and we talked in the last segment about bonds being so volatile too. So even the 20% that she had in bonds, that was a big part of her losses last year. They hadn't really made any changes. And that's the thing. She had been with an accumulation advisor. They had not positioned her into the preservation and distribution phase. And so we talked about that. She's like, I really thought they were doing that for me. I went and I addressed, you know, her Social Security. We put together a long-term care plan. We looked at some tax advantage plans for the back end of her retirement. And she said, these are all the things that I was looking for. You know, so she did become a client. And it wasn't that she was entirely unhappy with her advisor through the course of accumulating those assets. It's just now she had kind of crossed that bridge and she needs specialized help or someone that was focusing their practice in that area. So I was able to sit down with her and help her accomplish that, and she feels much better about things now.
That seems like a lot of extra work. Do advisors all do that? I mean, there's a lot of folks who use the phrase financial advisor. I'm a financial advisor, but you just said difference between accumulation and retirement. Is that something that somebody, when they come into your office, they need to know to ask, or they need to know to ask their advisor? Do you deal with retirement strategy? What would you say the most common person is who comes into your office that you help succeed?
Well, one of my goals when they leave my office is that they are asking the right questions, right? They may not know, but when they come in, when they leave the office, they know the questions to ask. You know, I don't work with people that are 20, 30, 40. Now, you know, all fairness, if I get a referral from a client, it's their son or daughter or something, of course I'm going to help them. But my practice, my education, the continuing education courses that I take, the continued studying that I do, what I pay attention in the market are things that focus retirees, people that are in that financial red zone. They're within 5 years of retirement, or they're already retired and they want to stay retired, right? They don't want to have to go back and get a part-time job. Or if they do, they want it to be optional, not because they have to, right? So I'm focused on that 50 and over, or that retirement red zone approach. So when that's what your focus, your practice is, you can become more informed on those different things that affect people in that situation. So by focusing my practice and not dealing with everyone across the board, right, that can fog a mirror. I hate that expression, but everyone knows what I'm talking about. By doing that, I'm able to focus in and really help the people that are in that situation.
You've been getting phone calls from viewers just like you who are watching the program right now. From these concerns, market volatility, interest rates, or even inflation, what have you heard more of? What is a bigger concern? The crazy volatility? Inflation? What's going to happen with interest rates down the road? What are people most scared about right now? I mean, I know you say, am I going to be okay? But
well, coming off of last year, 2022, market volatility is the biggest thing because a lot of people took a hit last year. So how can I recoup that money? without losing more of it. I mean, that's the big thing is, and because I took that loss, I was thinking about retiring next year or in 2 years, am I still going to be able to do that? So people want to know, I mean, I call it the on-track retirement review for a reason. People want to know, and when they say, am I going to be okay? They're saying, am I still on track, right? Am I still on track to retire when my goal was? And am I still on track to stay retired, or am I going to have to go back to work or do something part-time? So that's what I like to offer people when they come in is let's sit down, make sure that you're on track and that we're going to stay on track. And to do that, you need to have a written plan.
Okay. Do you mind taking us real quick through some of the elements of the actual written plan? So it's clearly not just about investments, or more importantly, decumulation. You mentioned a little bit about Social Security. What about all those health choices down the road? Do you talk about long-term care and Medicare and all that?
We do. So Angela in my office is actually our Medicare person. So that's all she does in the office. I mean, she helps around, do some other things, but her focus is on the Medicare and Medicare Advantage planning. So when our clients need that, we're able to say, okay, let me walk you over to Angela. Angela's going to get some information from you. She's going to run some numbers and try to help steer you through all of those, all of those different plans that are out there. When you're turning 65 or you're already 65, you get inundated with mail. I mean, if you're out there, you know what I'm talking about. Your mailbox is filled up. People are sending out flyers. We don't do that. We're not marketing it to help you. We're helping our existing clients go through that and go through that situation. We are looking at long-term care. Another thing that I do hear a lot from people is they'll say, my dad just went into a nursing home and he was there for a long time and they went through quite a bit of assets. I'm worried that I'm going to go through the same thing and I want my spouse or my kids to be okay. How can I address that? So we talk about that situation. Legacy. Some people want to leave money to their kids, believe it or not. It's kind of a toss-up when people come in. I'll ask if legacy is important to them. It's a 50-50. I mean, it really is. Some people say, nope, I did enough for them already. They're going to get what's left when I'm gone. Others, it's really important for them to leave a legacy or leave money to a charity. So I need to know that. And when the show's called What Retirement Means to You, yes, it's a play on my name, but it's really what does retirement mean to you? And so I have to get to know the person first. Then we look at the numbers because the numbers are just a math equation, right? We're going to sit down and figure out the math. But go ahead, I'm sorry.
Jerry, thank you so much. I'm sorry, we got to wrap it up today. I know we want to keep going, but we're going to come back every single week and keep talking about solutions. Folks, if you want to find out what retirement means to you, get your own on-track retirement review by calling the phone number, 844-878-1293. Thank you for watching. We'll be back again next week.